Ever wondered what a 1,000-ounce silver bar looks like? Yeah, it's big. Dusty Bullion is giving away a 1,000-ounce Comex silver bar to one lucky participant in our Silver Bar Sweepstakes. This bar is over 68 pounds of pure Can Someone Help Me Move This Thing silver goodness. So click the link below and enter for free, because someone has to win it, and you never know. It could be you.
This chart illustrates the U.S. monetary base, the running total of fiat Federal Reserve note cash now in circulation. The data was updated at the end of last March 2021, and there are now nearly 6 trillion of them issued. Since the September 2019 repo loan fiasco kicked off, the fiat US dollar monetary base has again exploded, as your eyes can likely glean. The reported monetary base, M0, has now risen over 82% in only 19 months through March 2021. So, we're on pace to double the fiat cash note base by the month of September 2021, only 2 years since the New York Federal Reserve had to step in and inject massive overnight repo loan liquidity. Now, given these recent rampings in fiat currency creation run amok, we must update our long-term silver price forecast and gold price forecast today. Stay tuned to the end of this video for those updated figures, and also you can find the Google Doc link in the show notes to see the data for yourself. We will also hear from a multi-billionaire who is now seeing that this decade, in terms of his life experience, having built much of his empire throughout this now nearly 50-year full fiat currency era, is reminding him much of the stagflationary, slow growth, high inflationary 1970s, early 1980 era.
Hello there, on behalf of SD Bullion, this is James Anderson. Before we continue forward, do me a quick favor, hit the like button below so others who might be currently asleep at the wheel can perhaps learn this critical information as well.
Before we look ahead, let us begin with a quick trip back in time to the last era in which gold and silver bullion revalued sharply in response to mass fiat currency debasement. In early January 1971, the then U.S. President Richard Nixon described himself as, quote, now a Keynesian in economics, unquote. By August 15th of that same year, his actions proved his words. Expansionist public spending and larger deficit budgets have seemingly only followed over these last 50 years of full fiat Federal Reserve note issuance. President Nixon's then temporary repeal of the post-World War II gold bullion-backed Bretton Woods monetary system is still ongoing. And here is quickly how it looked on our televisions way back then.
Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Let me lay to rest the bugaboo of what is called devaluation. The effect of this action, in other words, will be to stabilize the dollar. In full cooperation with the International Monetary Fund and those who trade with us, we will press for the necessary reforms to set up an urgently needed new international monetary system. Stability and equal treatment is in everybody's best interest.
Perhaps nothing is more permanent than even temporary suspensions of our old international monetary agreements. This week, multi-billionaire Sam Zell explained that growing price inflation in the U.S. and global economy is beginning to be reminiscent of the 1970s. Mr. Zell made much of his wealth in commercial and residential real estate during that stagflationary, slow growth, and rising price decade. Have a listen to his back and forth with Bloomberg's anchor, David Weston.
we're going to have inflation. He says we're going to have inflation, and we're seeing it already. As you know, you're seeing some of the corporate returns.
We're seeing it all over the place. I don't think, I mean, you read about lumber prices, but, we're seeing it in all of our businesses. I mean, the obvious bottlenecks in the supply chain arena are pushing up prices. There's just, it's very reminiscent of the 70s.
But Jay Powell, the Fed chair, says, don't worry about it. It's a short-term thing. It's transitory. He keeps talking about transitory. Do you agree with that?
Didn't the head of the Fed say that in the 70s, too?
Do you think we might actually head back to the 70s? Because we've had actually disinflationary forces for quite a few years now.
Well, I mean, basically from 13.75% Treasury bills in 1982, it's only gone down since, and inflation has gone down since. To a large extent, the reason we haven't had inflation is because we've reduced the multiplier effect. I mean, the usual, historic perspective was for every dollar of stimulus, that dollar was, rolled over 2 or 3 times and created growth. For the period that we just discussed, the velocity for sure decreased, and therefore inflation was, much more under control. I'm without a specific answer for you, other than I see the pressures almost everywhere, and I don't see what's going to make it temporary.
So you are an exceedingly shrewd investor. If that's your view about the risk of inflation, how does that change your investments right now?
Well, I think everything that you're doing, has to include the assumption that costs are going up. The fact that there is a shortage of employment. Whether it be home building or many other industries, they can't fill the jobs that they have. We've created a welfare society that is really discouraging people. When you can make almost as much or more by collecting unemployment insurance and supplemental this and supplemental that, that's pretty dangerous stuff. And clearly we're having trouble getting everybody back into the workforce because the alternative is so attractive.
So with a concern about inflation, at least the possibility of inflation, does that drive you into certain assets such as commodities, such as real estate, some of the traditional ways that you avoid it, or for that matter, gold?
Well, I think that the whole issue of fiat currencies is a very real issue. The United States is not the only country in the world that's printing too much money. Obviously, that one of the natural reactions is to buy gold, which I've actually done for the first time in my career. And it feels very funny because I've spent my career talking about, why would you want to own gold? It costs, it has no income and costs to store. And yet when you see the debasement of the currency, you say, what am I going to be able to hold on to? In the same manner, I think all of the discussion about cryptocurrencies are all in response to the whole question of, are fiat currencies going to, diminish the value, and will they be a non-store of value going forward?
In making long-term silver and gold price projections, we mathematically lean on U.S. financial history. For example, we cite past historic gold price manias like the post-U.S. Civil War greenback revaluation, the gold confiscation and U.S. dollar devaluation of 1933 to 1934, the 1970s-1980 commodity full fiat currency bull market, and this current 21st century largest ever bullion bull market ongoing. There's a repeating near average lifetime long precedent of official U.S. gold reserves, occasionally revaluing to cover over 40% of the outstanding fiat currency notes of issuance. That is our conservative long-term price target thesis. And while it's simple arithmetic, likely to be borne out yet again, the road from here to there will most certainly get stranger and more volatile as time unfolds. No fiction writer is capable of dreaming of what is coming to pass. I'll leave a publicly available Google Doc worksheet link in the comments and show notes below. Go yourself to see the data since our last update just 2 months ago. The new long-term gold-silver fiat Federal Reserve note price projection here at SD Bullion has a gold price target of now nearly 9,000 per troy ounce and silver nearly 300 per troy ounce, based on the gold-silver ratio tightening down to 30 in such a mania. For long-term savers and investors, one could, and we contend that one should, take a prudent physical precious metals position. Strap in and brace for a wild ride ahead. Thank you for watching, and as always, take great care of yourselves and those you love.
If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.